Assalamu alaikum wa rahmatullahi wa barakatuh. How are you, brothers and sisters? And this is the last part, or part number 4, related to the materiality and audit risk. In this part, we will focus on the audit risk model, and we will discuss all matters related to it. So this is the formula for the audit risk model. As we can see here, we have the audit risk equal to inherent risk multiplied by control risk multiplied by deduction risk. And we can see here that we put the inherent risk and control risk within one circle, which is they are related to each other and they are controlled by the client company. And both of them, they are representing the risk of material misstatement in the financial statement. So the auditor will attempt to assess and check the inherent risk as well as the effectiveness of the control risk. And then the auditor will set up the audit risk. So how much is the risk that the auditor will plan to accept? So it will be in this side. And then if we have the 3 in the planning stage, the auditor will be able to calculate the deduction risk. Again, just to simplify, as we mentioned just now, the audit risk, we set it up, the auditor will set the audit risk, and then inherent risk and control risk will be assessed by the auditor. The auditor will assess the inherent risk related to the client business risk, and also the auditor will assess the internal control system risk, assess the effectiveness of the internal control system, and then by then the auditor will be able to calculate and solve the deduction risk and get the deduction risk. Here, let's say the limitation of the audit risk model. It's important to know that it's not ultimate or absolute model. It is just a model that can simplify and practically reflect the risk, the integration of risk between the risk related to the business and also the customers, which the client, sorry. So which will help the auditor to set up the risk, assess the risk, and also plan for the materiality threshold and the sampling level. So the first one, the model assume that the component of the model, which is inherent risk, control risk, and deduction risk, are independent of each other, and this is not actual, not real, because in practice the dependency is existed between the inherent risk and the control risk, which is inherent risk. The more inherent risk is related to control risk, because if we have strong control risk, it will reduce the inherent risk. The auditor assessment of the inherent risk and control risk may be different from the actual levels of the inherent risk and control risk in reality or in practice. Last one is the model. The model of audit risk does not consider the possibility of non-sampling risk. Now, let us say the impact of engagement risk on the acceptable audit risk. Based on the model, the audit risk model, which is audit risk equal to multiply inherent risk, multiply control risk, and deduction risk. So if you remember, we will we mentioned just now that the inherent risk and control risk we will assess, and the inherent the acceptable audit risk we will set. So setting the acceptable risk, it is in the planning stage. So the auditor will decide the engagement risk in the early stage of the auditing, or the early stage of the relationship with the client, and that risk will be used to modify the acceptable audit risk. So the engagement risk comes first, and it will be the input for one of the input to assess the or to set up the acceptable audit risk. So let's say, what is engagement risk actually? What is engagement risk? So engagement risk, from the name, that any risk that the auditor will face, or any harm that the auditor will face and carry, associated with the engagement with particular client. And this risk of engagement may be as reputation, losing of reputation, or losing of financial interest. So the good example, I will discuss it in the next slide. And okay, here, as I mentioned just now, engagement risk is the harm that the auditor will suffer associated with an audit engagement to a particular client, and it can include losses of reputation from being associated with the particular client, or financial losses of that association. I bring this picture. I believe it's quite related to what we are discussing just now. So if you hang up with the bad guys, and people will look at you and consider that you are a bad guy also, even you mention that you are good and so on, but that the bad environment, the surrounding people, will reflect their attitudes, and the view, people will view that guy as a bad guy. So that's same with auditor. If the auditor keep engaging with very risky, less integrity client, that will be reflected in the view and reputation of that CPA and auditor firm by the other client and regulators, so bankers as well. So all the interest parties will consider this auditor is less highly risky, engaging with high risk clients, and less integrity as well, like his clients. Now let's say how we supposed to set up and plan or decide the acceptable audit risk. As we know, the acceptable audit risk, we need to set it up as low as possible, the acceptable low level. What is the acceptable low level? Is it normally we give it normally the range of the acceptable audit risk from 10 to 1%, meaning that the acceptable audit risk, the auditor willing to accept 10% of risk of the auditing process. So having mistake by the auditor, either sampling mistake or through or non-sampling mistake, so the auditor will accept 10% or 5% or 2%, sometimes 1%. So having said that, this one will be reflected to the materiality level, will be reflected also into the sampling, the accumulating of the evidence, as well to the cost of auditing. So what is the factors? How we decide? How the auditor will decide the acceptable low level of audit risk? Is it 2, or 1, or 5, or uh, uh, between this? So what is the main measure on that? It is the professional judgment, as we always say that the auditor should have and practice professional judgment, and we mentioned several times that professional judgment is not it's not a certificate, it's not a skills that you get from the study. It is about establishing criteria through the experience of work, audit experience of work, and experience of dealing with that particular customer or client, sorry. So let us look into this example. Let's say we set up the acceptable audit risk at 1%. So it means the confidence level is 99%. So acceptable audit risk plus the confidence level will be 1. So if we set up, sorry, let me it over. So if we set up the acceptable audit risk as, let's say, 5%, so the confidence level will be 90%. What does that mean? That means that the auditor is confident with the capability, with the accuracy of the auditing process of 95%, which means the auditor will ensure that he has the experienced team, the enough time and enough staff to conduct the auditing with confidence of 95%. If it is 1%, means 99% of confidence, which means more cost and more time and effort the auditor and the audit team will do. If less, then it will, let's say it's 10% or 15%. So if 10%, let's say the confidence level, the audit risk, then we will have the confidence level as 90%, which means the auditor will do less work. So in that case, we can see here that it is about the cost also. It's related to the audit risk is versus the cost and time balance. So when the auditor in the stage of deciding and setting up the audit risk, they need to consider the cost and time, because cost and time will lead to more work and so on. Okay. In here, we will discuss the factors affecting acceptable audit risk. There are three main factors that may affect the setting up the acceptable audit risk. So number one is the degree to which the external users rely on the statement. What we mean by relying on the statement means the external users that rely and this will be influenced their decision of financing or selling on credit to the company based on the financial statement. So that may affect the acceptable audit risk. So the more the reliance of the external users, the more external users rely on the financial statement, the less the acceptable audit risk should be. So what's the factors that increase the reliability of external users on the financial statement is the company size. One is the company size. If the bigger the company, the more reliance on the financial statement, because more large companies having more suppliers and having more customers and so on, so that they will use the financial statement and rely on the financial statement more. Also the ownership structure, or we can call private company versus public companies. So for public companies, we know that the owners is relying on the in the financial statement more compared to the private, which is normally family or individual companies. So public companies, they will be more there will be more external users to rely on the financial statement of public companies compared to the private. Number three is the nature of the amount of liabilities, because we know if more liabilities, if the company rely on financing more, then the means the banks and the suppliers will rely more on the financial statement. But let's say if the company prefer to have less credit, means less debt, they try to buy on cash. Their strategy not to apply loan from the bank, so that will drive to less reliance of their financial statement. Okay, so those three main factors. For sure there is other factors, but this is the main factors related to the degree to which the external users rely on the statement. The second factor affecting the acceptable audit risk is the likelihood that the client will have financial difficulties, mean that the possibility of the client to have financial difficulties or bankruptcy situation after the audit report is issued. So what is the factors that may drive to this situation? One is the liquidity position. So the cash flow, if they have difficulties on cash flow, then it's there is a likelihood to have financial difficulties in the next year or the sequence year. Also the method of financing. If they rely on the financing, for external financing, like applying for loan and so on, so that there will be more possibility of facing difficulties and financial difficulties in the future. Nature of the operation. So because we have traditional companies or setup companies, startup companies, new companies that may operated like in highly technology environment. So that kind of complexity of nature of operation may drive to bankruptcy or financial difficulties in the soon future. Last one is about management competency. How we get this, what does it mean? Because normally if the management or the CEO or the CFO are not competent enough financially, that we may expect to have financial difficulties. The company may face financial difficulties because less competence management, then we will face the company will face financial difficulties for sure, because they have they have less knowledge and awareness how to handle the financial matters for the company. How we can get this information related to the management competency? By looking to the CV and also the board of directors decision, sometimes the minutes of the meeting and so on. The third factor affecting acceptable audit risk is the auditor's evaluation of management integrity. So if the management have less integrity or having dishonesty features, so the auditor should set up the acceptable audit risk as low, because he's accepting or she's accepting that due to the management less integrity, the financial statement may carry material misstatement, more possibility of material misstatement on the financial statement applied or prepared by the management. So what is the factors that may influence or shape the management integrity? First is the conflict of financial interest. So if the management having financial interest conflict with the owner of the company, so we expect that the management is less integrity level. Then also prior crime history of the management. Another indicator is the frequent disagreement of the ex auditor or the ex audit team. So that will bring some indicator that this management is having a problem trying to disagree with the auditor's work. Also the frequent of turnover of the key financials and internal audit staff. So in that case, it brings a question why they let's say if the turnover is very short, let's say 1 year, 2 years, they keep changing or resigning the financial manager or the internal audit staff, it drives to this management try to manipulate something on the financial statements, and the financial managers or financial staff and internal audit cannot accept it, and they resign from the company. So that's some factors that may affect the management integrity. The auditor should take these factors, the three main factors. First is the reliance of the external users on the financial statement. The second one is the likelihood of the client facing difficulties, financial difficulties after they issue the audit report. The third factor is related to the management integrity or the evaluation of the auditor's evaluation of the management integrity. For the first factor, the external users' reliance on the financial statement we mentioned just now, there are some methods to use associated with acceptable audit risk. So the auditor can examine the financial statements and read the minutes of the board of directors, discuss the financial plan with the management. For the second factor, the likelihood of financial difficulties, the auditor can use and analyze the financial statement for the difficulties using ratios like liquidity position ratios, profit and loss for previous years, as well as the financing and leverage ratios. For the management integrity, it has been explained in details in chapter 8 about the acceptable and continuous of the client, which is related to issues related to the integrity and ethical matters that the auditor face in whether to continue with the existing client or accept the new client. So you can refer to the chapter 8. Here, let us look into the links between the deduction risk, materiality, and sampling. So the lower the deduction risk we calculate, the lower the materiality threshold, and the more the sample size and evidence to collect. So sample size and acceptable audit risk is having inverse relationship. If materiality threshold is low, then a bigger sample size is collected. So we will have one table later on and one figure to explain this in better way, but this one just to illustrate that. Okay, here in this diagram we will try to explain and illustrate the relationship or the type of relationship between the component of the audit risk model, which is inherent risk, planned deduction risk, and acceptable audit risk and control risk. So the four models. Before we see the relationship between those components with the audit evidence, the audit evidence, let's say first the relationship between those factors themselves. So as we know that planned deduction risk is the calculated or the solve or the answer, the result of the audit risk model. So acceptable audit risk, auditor will set set it in the planning, and we remember what is the factors. What is the factors that influencing the acceptable audit risk? Is the three factors we mentioned in the previous slides. About the likelihood of facing the client financial difficulties, about the integrity of the management, and as well as the other factor related to the type of reliance, the level of reliance of external users of the financial statement. So that's the factors affecting the acceptable audit risk. Whereby the factors affecting the control risk is about the effectiveness of the control activities, the assessment of the control, the five component of control of internal control system, how effective that the system is, the environment of control environment, and so on. Inherent risk is about the system, it's about the nature of the business, it's about the several factors we have already mentioned. So that is not our concern here. Our concern here is the relationship between those components. So acceptable audit risk is having relationship with the planned deduction risk. So if the auditor set up the acceptable audit risk in low level, then that will drive to low level of planned deduction risk, and so on. So it is a direct relationship. But inherent risk and control risk having inverse relationship. So if the auditor set up the inherent risk in high level and control risk auditor based on the assessment of inherent risk and control risk, the auditor find that the assessment drive to control risk is very high and the inherent risk is very high, that will drive to low level of planned deduction risk. That goes also to the planned audit risk. So the control risk and inherent risk having also direct relationship to the planned audit evidence. So the volume of evidence will be more if the inherent risk and control risk is high. But if the assessment of the inherent risk and control risk is low, then the planned audit risk, the planned audit evidence, or the volume of audit evidence will be low. Whereby acceptable audit risk has inverse relationship with the planned audit evidence. So if the auditor set up the acceptable audit risk in high level, so it will, the planned audit evidence will be low. Okay, so that's simply the kind of illustration about the relationship between the component of the audit risk model with the planned audit evidence or the sample. Here we will try to explain the relationship of audit risk components of the audit risk model and the evidence or the amount of evidence required in each situation. So we have 5 situations here. We will see each one of it. So in case of the or scenario 1, we have the acceptable audit risk has been set as high acceptable audit risk, and inherent and control risk is very low. The planned deduction risk will be high, and the amount of evidence required is low. Why the amount of evidence is low? Because the plan of deduction risk is high. So we found that the deduction risk will be high due to the low control risk and low inherent risk. From the diagram we explained just now in the previous slide, you can look and refer when you try to understand and link between the table. The situation 2, we have acceptable audit risk is low, inherent risk is low, control risk is low, so it will drive to planned deduction risk will be low, and the amount of evidence required will be also medium. Then we will have situation 3, we have low acceptable audit risk. Auditors set up the acceptable audit risk in low level, and inherent risk and control risk is high. This will drive to low planned deduction risk, and then also high amount of evidence required. So we can see here that if the control and inherent risk are having inverse relationship with the planned deduction risk, and also having a direct relationship with the amount of evidence required, and whereby acceptable audit risk having inverse relationship with the amount of evidence required and having direct relationship with the planned deduction risk. In situation 4, if we set up the acceptable audit risk, inherent risk, control risk on medium level, then we will have medium planned deduction risk and medium amount of evidence required. Situation 5, if the acceptable audit risk is high and then inherent risk is low and assessment of control risk is is medium, then the planned deduction risk will be medium, and the amount. Okay, this table illustrating a hypothetical situation of different evidence among cycles on assume or presume company. So this is an example. So assessing the inherent risk in medium and in the sales cycle, then for the acquisition they assess the inherent risk in high level, payroll low, and so on. So that it just show in that scenario in this company how in a combination and segmental or cycle level, they set up the inherent risk, control risk, and then they also set up the acceptable audit risk, and then accumulating the planned deduction risk. If you notice here, we use medium, low, and high, which is quite qualitative aspect. If you notice, we didn't put figures or numeric or number here, like 2%, 5%, because most of the companies they prefer, or most of the auditor they prefer to have the qualitative quantitative indicators here, then they reflect it later on to the to a numeric. So this one is the continuous example for the other two cycles. After we discuss the audit risk type and the audit risk model, it is very important to link it and know whether we set up the audit risk on the level of the overall audit process or based on the segments. Both control risk and inherent risk are typically set for each cycle and each account. And this one, I can give you an example. The close example is related to the cash or the account receivable. Cash account, if we have the company dealing with cash, daily cash, like the grocery shops and so on, we will set up the inherent risk for cash as high, and the auditor will assess the control risk related to the cash account in that in this company. So, for example, they should have segregation of duties. They should have CCTV related to the to oversight or monitor the process of cash collection and cash deposit to the bank and so on. Supervision, independent supervision and review as well should be reviewed. So the auditor will assess control risk and inherent risk based on the account and each cycle and each account for the segment. So another example about the account receivable of the company having highly or 100,000 daily transactions selling on credit. So in that case, the auditor will consider it is quite risky. This account is quite risky. Account receivable is risky inherently. So the auditor will check the control activities applied on the account receivable management. So let's say whether they have credit limit process, whether they have segregation of duties, or how they handle the cash received and how they record and so on. So by now we should understand that the control risk or the audit risk is set up for segment, and the both component inherent risk and control risk will be assessed based on the cycles and the segment. Also for the audit objectives, it's also set for each account as we mentioned earlier. How about setting up the audit risk to the balance related audit and related audit objective, and also tolerable misstatement? It is common to assess inherent risk and control risk for each balance related to related audit objective, but it is not common to allocate materiality to the objective, to the balance related audit objective. This diagram is illustrating or explaining the relationship between the audit risk model, which we explained it earlier, with the planned audit evidence. Adding to that is the tolerable misstatement, because we discussed in a short while that tolerable misstatement and the audit risk model will be set in the segment and account level, not an overall audit. So tolerable misstatement is related to the planned audit evidence in inverse relationship. For the rest of the model, those model we already explained this, but only for inherent for the tolerable misstatement having inverse relationship. So it means the more or the if we set up the tolerable misstatement in high level, let's say, we will have less audit evidence. And when we say audit evidence, mean the sample size. Okay. This diagram will help us to understand the audit risk model for the planning evidence and evaluating the result. So in the planning the evidence will affect the substantive test of audit evidence, and also the evaluating the result by comparing the achieved audit risk, which come from the inherent risk, control risk, and achieving deduction risk, along with the acceptable audit risk that we set up in the beginning of the planning stage of auditing. So we will compare, and based on that, we will decide either to revise the assessment of risk or the setup of acceptable audit risk, or to consider more substantive audit evidence. So based on the comparing between the achieved audit risk with the acceptable audit risk, we will auditor will require to revise the risk and evidence. So auditor must revise the original assessment of the appropriate risks, and also the auditor should consider the effect of the revision on evidence requirement without the use of the audit risk model. So they need to consider the revision of appropriate risk of the assessment of risk, as well as for the evidence required in this client company. By now, we end up this chapter. We can conclude that the materiality and the planning or sampling is a very important topic in the auditing process, and the student is required to really understand. We can see how we in this chapter we try to link the risk with the materiality, with the sampling, and so on. We have several figures that explain this. So please try to understand, try to integrate and look into the textbook if you have lack of explanation to those figures. And if you need, you can refer to or email me for anything, or WhatsApp me. Okay, thank you. I hope you get some knowledge on this. Thank you so much. Wassalamu alaikum wa rahmatullahi wa barakatuh.